get a market expert in to interpret the Fed for us. Jan Hui, the global market strategist at JPMorgan Asset Management company, joins us on the phone line. Jan, good morning. Thank you very much for joining us. The odds have risen for a Fed rate hike. Do you think the markets could see more rallies as we get closer to December?
Yes, I think that's quite possible. We could see more rallies. It does seem that the Fed statement has really raised people's expectations for the U.S. strength. I think for the moment at least, the prospects of a stronger growing U.S. will outweigh most of the other worries that we have seen. So we could see some more rallies on the back of this. As already mentioned from the analysis of what the Fed's latest statements, it does seem we have a greater chance of a rate hike in December. The chances are, based on what the futures are saying, they're just a tick over 45% at the moment.
Okay, so there's a 45% chance of a rate hike in the December policy. Ian, good morning. Given that the belief is that the U.S. economy is now doing well, what's your sense about, the developed markets and the emerging market debate? Which asset class do you think could do better in the next 6 to 12 months?
Hey, good morning. Yep. So over the next 6 to 12 months, we're still looking at riskier assets. We still believe, based on the potential rate hike, it should be equities still over fixed income, just based on what we do expect to happen when interest rates do start rising in the U.S. We do know that the BOJ and the ECB, they're still looking to ease more, but just with the way the Fed putting back that December rate hike back on the cards, back being a possibility, we still think being more positive on the equities.
No, my question was more to do between developed markets and emerging markets. Where do you see the higher scope of returns?
Okay, sure. Yep. On the developed markets versus the emerging markets, we're still more positive on the developed markets at the moment. The emerging markets still have to deal with the weak global trade, sluggishness in China. China is the main driver for emerging markets right now. We do still seem to see some weakness there. We do have some hope that with the current fifth plenum that is currently going on in China, the meeting of the various leaders there may be some statement forthcoming for their plans for economic growth and more reform that might revitalize and cause a catalyst to see some more positives in the Chinese market and the Chinese economy. But for now, for our own JPMorgan Asset Management view for our team, it's still developed markets over emerging markets.
No, that's a fair point. But, over the last couple of weeks, we have seen funds returning to emerging markets. Does that continue, or with the Fed statement, there is a greater flow of funds, a reversal of funds towards developed markets?
Yeah, so I sort of think that we've seen a bit of a calm down over the panic that we've seen most recently. So there is still some funds going back to emerging markets. The positives from the strength of a U.S. economy probably outweighs what people worry about a rate hike would cause. With the U.S. growing more strongly, that should mean better news for global growth, more demand for emerging market exports, which should help things, I think. So we're still seeing a bit of better news for those EM flows, but our view overall is still mainly the developed markets over the emerging markets based on the relative growth.
And what's a pecking order in the emerging markets? We had some bad banking numbers in India. That's a domestic story. But what's your pecking order?
Overall, my view, I'd still be mainly positive on India over most of the other emerging markets. Mainly still based on our policy reform view. Yes, we do know land reform, GST, they still have disappointed a bit. There still seems to be some stalls in investment, but ease of business is improving, policy is improving there. I saw some latest survey that it seems to suggest that India is improving in its ease of business rankings in the world. So still positive on India. China is a bit trickier. We're probably still waiting and seeing if see the results of the fifth plenum over the next few days to see if there is any policy reform or state-owned enterprise reform that would mean that there is some positives in China. Most of the other emerging markets, they vary quite a bit significantly. Still weakness in global trade, so mostly those emerging markets that are reliant on trade are still probably going to face a bit of weakness.
All right, Jan Hui, thank you very much for joining us, for putting that into perspective. Well, so Indian outperform at least is confirmed by the JPMorgan expert. Some statements coming in from Monitor's path. I think that's more the loan conversion into equity. I don't think it's a fresh raising of equity, but
they're converting loans into equity shares to lenders under the SDR, or the Strategic Debt Restructuring Circular of the RBI. So they'll convert the unsecured loan brought in by the promoters as